Well, hi everyone, and welcome to this week's edition of Feeling Smarter. As always, I'm joined by my co-host, who once again is with me here in Melbourne to discuss the topic of insurance in SMSFs as we have our upcoming SMSF Insurance Masterclass. So welcome, Tim.
Aaron, always a pleasure.
So today we're going to move along to the unfortunate position where an individual dies and they have an insurance policy as part of the death benefit to be paid. So when we think about that issue, what are some of the areas as practitioners we need to be cognizant of as we work through this difficult stage with our SMSF clients?
Yeah, look, there's a number of things, right? So there's a few areas that we'll just touch on briefly today, and one is the deductibility, right? So we need to understand the ramifications of both claiming and not claiming the premiums that we're paying from a insurance policy point of view. Now that might sound odd because we would naturally go, well, of course you're going to claim it.
Yeah.
But then we've got to ask the question, or the question always has to be posed is super the right environment? Right, so yes, we have the capacity to claim a tax deduction, but is super the right environment based on who is the end beneficiary, right? And so if we're talking about a death benefit to a spouse, then they're a tax dependent, then there's no tax to pay. If we're paying it to a non-tax dependent, so potentially an adult child, then we have our 15% standard tax on death. Subject to claiming a premium, subject to dying prior to age 65, and then paying that benefit to a non-tax dependent. We also have an untaxed element uplift, so there is potential for a further 15%, so a total of 30% on the future portion of that payment. So having an understanding and appreciation for that is something that's often overlooked when we talk about, it's great to hold insurance in super because of the deductibility, but it may not be so great from a tax point of view if the end beneficiary is not a tax dependent.
Well, you can add to that, even from a dependent beneficiary point of view, the reality is subject to the quantum of the insurance, there's going to be limitations potentially around things like the transfer balance cap, maybe even in the context of the proposed Division 296 tax measures as well. So thinking about, and historically, sort of loading up insurance in superannuation never posed an issue because of the fact that the beneficiary, being a spouse in this instance, if we use that as the example, would in essence be able to turn that into an income stream in the fund, and subject to their ages or the age of the deceased member, would literally be taking that as a tax-free benefit payment to them on an ongoing basis. But now, as we start to introduce, or now that we have been introduced to the transfer balance cap and the potential additional tax at 3 million, looking at the structuring of that insurance is not equally as important as it is where you get to non-tax dependents, but it adds an additional layer or layers to that overall discussion around where that needs to be held.
Yeah, absolutely. And probably then to take it even one step further, and something that I've certainly been speaking about for many years, and we've spoken about it on one of these sessions before, and that is the future liability to pay a benefit deduction, where we forego the deduction based on the premium in the year that we make the payment of the death benefit, and instead we claim on the future portion of the benefit, again relying on the member passing away prior to age 65. But does that give us a large tax deduction that will help offset future tax liabilities of the fund around contributions and other
the fact that it might
income.
be an amount in accumulation phase, or whatever the case may be.
That's right. And again, when you link that to a transfer balance cap where you can't put everything into a pension, maybe there's benefits there to consider, and all that forms part of what we're going to be talking about.
Yeah, absolutely. Well, I guess, Tim, is there anything else that we want to cover off on? We naturally have this masterclass coming up, so we hope you've enjoyed a lot of these sessions where we've dived into many of the elements there. Tim, I guess any sort of final comments as we wrap up this series of insurance masterclass topic?
Look, I think probably the main thing I would say is that we've focused quite heavily on the key conditions of release and how they're linked to insurance, but insurance doesn't necessarily stop there in the super environment. So there's other reasons to have insurance. It might be around investments. It might be around things like collectibles and personal use assets where there is a requirement to insure, and that's taking a completely different look at insurance.
Yeah.
But all of that will be part of what we talk about when we cover off an insurance.
Yeah, and even the interests of where you might be deducting premiums from, which we're going to be also talking about, because that could have quite a substantial impact on the way in which the beneficiary of those proceeds ultimately takes the benefits as well. So they're going to be just some of the areas that we'll be talking about. Again, if you want to find out more about how you can be a part of our upcoming SMSF Insurance Masterclass, visit our website, smartersmsf.com/events, to be held Tuesday, the 12th of November. Thanks again, Tim.
Always a pleasure, Aaron.
Have a great rest of the day, rest of the week. Bye for now.
See you all.